This home right here just dropped by $500,000, and it's not the only one. From Phoenix to LA, Austin to Boise, sellers are panicking, buyers are ghosting, and headlines are screaming crash again. But is the market actually collapsing, or is this just what a correction looks like? Let's break it down, because if you're thinking about buying or selling, this directly impacts you. So look, I've been in real estate for a long time. I've flipped hundreds of homes, wholesaled thousands of houses, and built one of the biggest retail real estate companies in the country. And I've never seen a housing market quite like the one we're seeing now. Some homes are sitting for months, others are being slashed by hundreds of thousands of dollars, and yet in some neighborhoods stuff is still flying off the market. So it's super confusing, even for experienced agents like me. So today I'm going to break down exactly what's going on, the facts, the data, the emotional triggers driving buyers and sellers, and what this all means for you, whether you're trying to buy, sell, invest, or just understand what the hell is happening. So if you get value from this video, do me a huge favor, hit that like button and make sure you smash the subscribe button by the end of the video. So let's start with the obvious. Yes, prices are falling in certain markets. So according to Redfin, more than 1 in 5 listings in pandemic boomtowns like Boise, Austin, and Phoenix had price drops in the last 30 days, a sign the demand is softening fast in all the overheated markets. Los Angeles County is seeing a serious shakeup. About 30% of listings had a price cut in May, and in the city of LA alone, over 20% of sellers adjusted their prices down. Statewide, California's inventory is up 34% year over year, pushing sellers to act quick. Some are slashing prices aggressively to stay ahead of the slowdown, especially in the luxury segment, where homes are sitting and showings are thin. Now, I personally know a lot of investors who were over-leveraged on short-term rentals and are now panic selling, especially in saturated vacation markets. Some of them are offloading at a loss just to reduce the burn. But here's the bigger picture. Nationally, home prices are still up about 3.4% year over year, with the median now at about $402,000. And if you just zoom out over a 5-year perspective, the Case-Shiller Index indicates that prices are around 31% higher than pre-COVID levels. Meaning, this isn't a collapse, it's really just a recalibration. And the correction is hitting the exact markets that overheated the fastest. All the pandemic boomtowns that we talked about a little while ago, like Austin, Boise, Phoenix, and Tampa. So let's talk about what is really slowing the market, which is, of course, interest rates. So right now, the average 30-year fixed mortgage is hovering around 6.9%. More than twice as high as the historic low of 2.65 back in January of 2021. And here's the impact. If you bought a home for $600,000 at 3%, your monthly P&I would be about $2,530. At 6.9%, that same payment jumps to around $3,947, which is a $1,417 a month increase. And that doesn't even include property taxes, HOA, PMI, or insurance. Most Americans are now paying more than 35% of their total income towards housing costs, which is the highest it's been since the 1980s, well above the affordability benchmark of 30%. And that's why qualified buyers are waiting, and borderline buyers, they can't qualify at all. In fact, a LendingTree survey from May of 2025 found that 62% of renters are worried they'll never be able to own a home, a sobering sign of how affordability is crushing the American dream. So it's not about desire anymore, it really is about feasibility. Buyers are doing the math and they're realizing the numbers just don't work. The math is ultimately emotional. It causes a lot of fear. And when people fear that they're buying at the top, they ultimately freeze. So I had a conversation with a first-time buyer last week, dual income household, good credit, saved for 5 years. And even they couldn't get approved for a $500,000 home without stretching themselves. That's where we're at. This is more than a market shift. It's really a confidence shift. And builders aren't filling the gap either. A recent May 2025 article described it well. Builders are stuck between surging costs and shaky demand. The issue is twofold: demand and uncertainty. And many Americans simply can't afford today's prices with nearly 7% mortgages. And nationally, home values are up roughly 30 to 35% from pre-COVID levels. And in many Sunbelt markets, that number approaches or exceeds 50%. And on the supply side, roughly 3/4 of builders say that they're struggling to price homes properly. Material costs remain volatile, labor is tight, and they can't raise prices to match. So they're slowing down, cautiously waiting instead of ramping up construction. So while inventory may feel like it's rising, it's still artificially tight. Now demand? It's not just soft, it's nearly frozen. Mortgage purchase applications are at a 28-year low per the MBA. Pending home sales are down 2.5% year over year and fell 6.3% in April alone. Existing home sales are at their weakest pace in 7 months, and on the ground, open houses are completely empty. Buyers are burnt out, or they're boxed out, or they're just waiting on the sidelines. This isn't a lack of interest, it's a lack of affordability and trust that now is the right time to buy. So let's clear this up. This is not 2008, and I'll tell you why. Back in 2004 through 2007, nearly 30% of all new mortgages were adjustable rate loans. Loans that later reset and played a big role in the housing crash. Today, that number is sitting around 8%. Now this translates to roughly 1.7 million homeowners who purchased homes with adjustable rate mortgages. In 2008, 12 million homes were underwater. Today, only 1.2 million have negative equity, less than 2% of all homes with a mortgage. And the average homeowner today has $300,000 or more in equity. We're not dealing with a foreclosure tsunami, we're dealing with paralysis. Most sellers have too much equity to walk away. They'd rather wait. So what happens next? Well, homes are taking longer to sell. We're up to about 50 days on the market nationally compared to 46 days last year and around 55 to 60 days pre-pandemic. So it's not a crisis, but it is a signal that momentum is slowing. But let's say rates drop to even 6.5%. I would expect a mini surge. There's a massive pent-up demand from the first-time buyers and millennials who have been waiting for a break. But long term, I'm still bullish. But in the short term, volatility is definitely here, and that is ultimately where smart investors thrive. So let's talk a little bit about strategy, because the market is still full of opportunities for the people who know how to play it. Sellers who are actually closing deals right now are getting smart. They're offering 2-1 rate buydowns, paying closing costs, staging their homes properly, and pricing just under the major thresholds to drive traffic. For sellers, offering a 2-1 buydown can make their property more appealing in a competitive market, particularly when we see mortgage rates hovering at 7%. Buyers who are winning in this market are running the numbers differently. They're negotiating seller credits, using DSCR loans, and considering assumable mortgages, and in some cases, they're even using creative financing like subject to or seller carrybacks. In fact, according to Redfin, about 44.4% of U.S. home sale transactions in Q1 of 2025 included seller concessions, such as covering closing costs, paying for repairs, or offering mortgage buydowns, which is up 39.3% compared to last year and is just shy of the record set in 2023, which was 45.1%. And for investors, they're not buying based on appreciation. They're buying based on cash flow and loan structure. One of my partners just closed a fourplex where the seller paid $18,000 in closing costs and he locked in a 6.75% rate using a DSCR loan with 0 tax returns needed. And it cash flows on day one. The whole point is, there are still deals out there. But if you're trying to play the game using 2021 rules, you're gonna lose. It's the first time in years that buyers have real leverage, and if you know how to use it, there's a massive opportunity out there. While Wall Street headlines get the attention, the real pulse of the market is coming from small investors, everyday landlords, and real estate entrepreneurs. According to a 2025 National Investor Survey, 65% of single-family home investors said their biggest frustration is finding deals that actually cash flow. And that number jumps to 78% in high-cost markets like the West. Still, 45% of those surveyed plan to expand their portfolios in the near term, despite the uncertainty. And here's the kicker. 50% of small investors say they're willing to accept mortgage rates up to 7% on their next property as long as the numbers pencil. That means they're not sitting out, they're not on the sidelines, they're just adjusting, getting more creative, running tighter underwriting, and looking for good terms. This is the kind of market that separates speculators from strategic buyers. When the emotional buyers step back, the disciplined investors step in. And the takeaway? Compete differently. Think like an investor, not a speculator. Lock in long-term value, not short-term wins. So look, if this breakdown helped you see the market even a little bit more clearly, do me a huge favor, like the video, comment down below, and make sure you subscribe. I'd love to make a lot more real estate content for you that keeps you up to date and informed so you know what to do when you're out there trying to navigate the landscape of buying and selling real estate. I really appreciate you staying to the end of the video, and I look forward to seeing you in the next one.